Good morning, everyone. Let me start with a simple question. What would you do if the system went silent tomorrow? No price feeds, no confirmations, no guarantees, because right now, that silence is already happening. Bullion showing, down the LBMA offline, and silver prices crashing, and the headline reads, the $90 trap. But here's the truth. This moment is not just about metals. It's about mindset. It's about awareness, and it's about whether we choose fear or strategy. Silver prices don't usually fall quietly. They fall with consequences. What began as a sharp dip quickly turned into a full-scale jolt across global markets, catching many investors off guard and forcing analysts to reevaluate short-term expectations. One moment, charts appeared stable. The next, red candles dominated screens worldwide. If you blinked, you missed it. That's how fast confidence can shift in today's financial environment. Here's a hook most people overlook. Sudden price drops are rarely just about supply and demand. They're about psychology, leverage, and positioning. When silver crashed, it wasn't simply a commodity reacting to headlines. It was a market responding to pressure. Institutional traders adjusted exposure, algorithmic systems accelerated selling, and retail investors were left trying to make sense of a move that felt abrupt and overwhelming. And this is where emotion enters the picture, and emotion is expensive. Volatility like this exposes a deeper truth about modern markets. Silver, long viewed as both an industrial metal and a store of value, sits at the intersection of manufacturing demand and investor sentiment. When prices fall sharply, it sends ripples through multiple sectors at once, from solar production to electronics to portfolio hedging strategies. For seasoned participants, this isn't panic territory. It's signal territory for unprepared investors. It becomes a lesson in how quickly paper wealth can fluctuate. But let's pause for a moment and ask a smarter question. Who benefits when prices crash? History shows that rapid declines often create accumulation zones for large players, while smaller investors hesitate. Big money doesn't wait for reassurance. It positions during uncertainty. That's the real game behind the charts. While headlines focus on losses, professionals study volume, liquidity, and market structure. They understand that every sharp move shakes weak hands and rewards disciplined ones. Another hook worth noting is the growing disconnect between price action and physical demand. Even as spot prices slide, interest in tangible silver frequently rises, revealing a tension between paper markets and real-world buying behavior. This divergence matters. It highlights how futures contracts and derivatives can drive prices short-term, while long-term value is anchored in scarcity and utility. For everyday investors, this moment is a wake-up call, not to rush blindly, but to think strategically. Markets don't punish ignorance, they simply reward preparation. Silver's sudden drop reminds us that waiting for perfect clarity often means arriving too late. Financial resilience isn't built during calm periods, it's forged in volatility. Those who succeed are the ones who stay informed, manage risk, and resist the urge to follow the crowd when uncertainty takes center stage. Because in times like these, price movements aren't just numbers on a screen, they're tests of discipline, awareness, and mindset. And the people who master those elements don't just survive market swings, they learn how to move with them. Bullion system disruptions didn't just inconvenience customers, they sent a ripple of concern through the entire precious metals community. Imagine trying to access critical financial information at the exact moment volatility peaks, only to be met with loading errors or unavailable services. That's not a minor technical issue, that's a moment that tests trust. When one of the largest retail bullion platforms shows signs of instability during a market shock, investors don't just notice, they remember. Here's the hook. Markets run on confidence, and confidence runs on access. As silver prices move sharply, thousands of buyers and sellers rush to check availability, lock in orders, or reassess positions. Instead, many encounter delays or outages. In fast-moving markets, seconds matter. When systems go down, decision-making freezes. For experienced investors, this highlights a hard reality. Digital platforms are only as reliable as the infrastructure behind them. Convenience disappears instantly when demand spikes, and those who rely solely on centralized systems can find themselves powerless at the worst possible time. These disruptions also expose a deeper structural issue. Retail bullion dealers operate at the intersection of physical inventory and digital execution. When traffic surges, pricing updates lag, or order systems stall. It reveals how tightly stretched these operations can become under pressure. It's not just about website capacity, it's about supply chains, hedging mechanisms, and real-time pricing feeds. When one piece slows down, the entire machine feels it. But let's zoom out. Why does this matter beyond one company? because Bullion represents a gateway for everyday investors into the precious metals market. And when that gateway narrows, even temporarily, it amplifies uncertainty. People begin to ask uncomfortable questions. Is inventory really available? Are prices accurate? Can orders actually be fulfilled? These moments remind us that liquidity isn't guaranteed, especially when everyone moves at once. For decades, the LBMA has served as a backbone for pricing standards, market coordination, and credibility across the gold and silver ecosystem. Banks, refiners, dealers, and large investors rely on its benchmarks to guide billions in daily transactions. So when access goes offline, even temporarily, it exposes how dependent the global system has become on centralized information channels. In a market driven by confidence, silence can be louder than any headline. What made the timing especially striking was the broader backdrop of falling silver prices and retail platform disruptions. Investors were already searching for clarity, and suddenly a key institutional reference point was unavailable. That's when uncomfortable questions start circulating. Is this a routine technical issue or a sign of deeper liquidity stress? Are pricing mechanisms functioning normally? Is physical supply matching paper claims? These aren't conspiracy theories. These are standard risk management questions asked by professionals when systems go quiet. Here's another hook most people overlook. Large institutions don't wait for public dashboards to come back online. They operate through private channels, direct counterparties, and negotiated contracts. While retail investors refresh browsers, major players continue moving capital behind the scenes. This moment highlights a persistent imbalance in market access. The public sees outages, the insiders see opportunity. The LBMA going offline also reignites a long-running debate about paper versus physical markets. Futures contracts, unallocated accounts, and derivatives can move prices instantly. But physical metal doesn't move at the speed of algorithms. When official platforms become unavailable, attention naturally shifts to what's real and deliverable. Suddenly, possession matters more than quotes. Availability matters more than spot prices. And trust becomes the most valuable asset in the room. For seasoned observers, this episode serves as a reminder that modern financial systems are highly interconnected and highly fragile under stress. A disruption in one node can ripple outward, affecting sentiment far beyond its immediate reach. It reinforces why diversification isn't just about holding different assets, but about understanding how markets function when pressure builds, knowing where information comes from and how trades settle, and who controls liquidity becomes critical. And perhaps the most powerful takeaway is this: markets reveal their true structure during moments of disruption. Calm periods hide weaknesses, volatility exposes them, and when institutions go offline and prices swing sharply, it becomes clear who is prepared and who is simply reacting. These are the moments that separate passive participants from strategic thinkers. The moments when awareness turns into advantage, and those paying attention gain insight that charts alone can provide it. But when experts warn about the $90 trap, they are pointing to a subtle yet powerful psychological pattern that ensnares investors more often than market mechanics do. It's not a trap in the conventional sense of a scam or fraud. It's a mindset that convinces people to wait for the perfect price, the ideal timing, or the ultimate signal of certainty before taking action. And here's the hook. In volatile markets, waiting for perfection is the surest way to miss opportunity. The $90 mark becomes a mirage, a psychological barrier that can cloud judgment and stall decision-making at precisely the moment clarity is needed most. This trap thrives because human nature seeks reassurance. Investors look at charts, scan headlines, and monitor sentiment, hoping to catch the moment when risk feels safe, but markets rarely offer perfect timing. They don't pause to accommodate hesitation. When silver was moving sharply, those fixated on a target price, like $90, often found themselves frozen, watching opportunities pass while others acted decisively. This is the hidden cost of psychological traps. Indecision in a fast-moving environment is far more expensive than a calculated mistake made with awareness. The $90 trap also illustrates how external signals can hijack judgment. News articles, social media chatter, and the opinions of so-called experts amplify the illusion that there is a single correct entry point. Investors internalize these signals, mistaking external validation for market truth. But volatility, by its very nature, is unpredictable. Relying on consensus thinking in moments of disruption is a strategy, guaranteed to lag behind reality. Here's the hook most people miss. Market movements don't wait for consensus, but opportunity often rewards those willing to move independently, anchored in preparation, rather than panic. Another subtle aspect of this trap is the misinterpretation of short-term price swings as indicators of long-term value. When silver dips, many assume it is too late or too risky to buy, reinforcing the waiting mindset. But sharp declines can create accumulation zones for informed investors. The trap is not just psychological hesitation, it is the tendency to confuse temporary volatility with permanent loss. Those who recognize this distinction can position themselves to take advantage of moments that others misread as danger. Finally, the $90 trap underscores the importance of strategy over reaction. Emotional investing magnifies risk, while disciplined planning, understanding market cycles, liquidity, and demand dynamics allows investors to act confidently even when uncertainty dominates headlines. The trap exists in everyone's mind until awareness replaces hesitation. And once that awareness takes hold, what once seemed like a looming barrier becomes a landscape of opportunity, revealing how timing is less about perfection and more about readiness, courage, and perspective. The growing tension between paper markets and physical demand has become impossible to ignore as silver experiences dramatic price swings. On the surface, futures contracts, ETFs, and other derivatives appear to dictate the direction of silver prices, creating the illusion of a fully liquid and balanced market. But here's the hook. These paper-based instruments often move independently of actual physical supply, meaning the charts may tell one story while reality tells another. When prices drop sharply on paper, the demand for tangible metal frequently rises, exposing a disconnection that many investors fail to appreciate until it becomes critical. This divergence is more than theoretical. It's a structural feature of modern commodities markets. Paper contracts allow vast sums of silver to be traded with no physical delivery required, providing liquidity but also amplifying volatility. Meanwhile, industrial users, jewelers, and bullion collectors continue to compete for physical metal. When these two forces collide, a falling paper price alongside rising physical demand, the market experiences tension that can accelerate price moves and create confusion among less informed participants. The hook here is subtle but powerful. Understanding the gap between virtual trading and real-world possession is often the difference between panic and strategic action. Institutional players are acutely aware of this imbalance. They monitor delivery warehouses, inventory levels, and shipment schedules to anticipate shortages that paper prices might not immediately reflect. Retail investors, meanwhile, often react solely to the numbers on the screen, mistaking them for absolute truth. This misalignment creates opportunity. When paper markets swing wildly, savvy participants use the knowledge of physical supply constraints to position themselves, acquiring metal at discounts relative to intrinsic value, while the broader market reacts emotionally. The phenomenon also highlights a recurring risk in commodity trading: liquidity illusion. Just because a contract can be bought or sold in milliseconds does not mean that the underlying metal can be acquired or delivered with equal ease. During times of stress, paper prices can diverge dramatically from spot and delivery prices, creating arbitrage possibilities but also exposing those unprepared to unexpected constraints. Here's the hook. What appears cheap on a chart may be unavailable in reality, and understanding that distinction requires foresight, research, and attention to market mechanics beyond headlines. Moreover, this tension illustrates a broader principle in investing. Surface-level data rarely tells the full story. True insight comes from connecting disparate signals: chart trends, inventory reports, industrial demand, and market sentiment to understand the underlying dynamics. Silver's current volatility, exacerbated by the divergence between paper and physical markets, underscores that price alone is never the complete measure of value. Those who recognize the gap between representation and reality gain a strategic edge, moving decisively when others are paralyzed by noise, uncertainty, or misplaced assumptions about what the market is. Actually signaling, in moments of market turbulence, the single most important factor separating successful investors from those who falter. The lesson for any investor is that reactionary behavior is costly. When prices swing violently, the first instinct for many is to sell, often locking in losses or abandoning long-term plans. Others may overcommit, chasing trends without proper risk management, but those who maintain a strategy grounded in research, diversification, and risk controls navigate turbulence differently. They pause to assess, compare actual market signals with long-term objectives, and make decisions that align with preparedness rather than impulse. Here's the hook. The same market that terrifies some participants rewards those who refuse to succumb to panic. Preparedness is also about understanding that volatility is an inherent part of markets, not an anomaly. Sharp declines in silver, disruptions in trading platforms, and offline institutional benchmarks are all signals that the system is testing its limits. Strategic investors don't view these signals as random chaos. They interpret them as data. Each fluctuation provides insight into liquidity, supply-demand imbalances, and market sentiment. The more you study these patterns, the more you can anticipate potential opportunities and risks before they appear obvious to the majority. Another key aspect of strategy is diversification, not just across assets, but across access points, information sources, and execution methods. Relying on a single platform, one benchmark, or a narrow perspective introduces hidden vulnerabilities. Those who cultivate multiple channels, track both physical and paper markets, and stay informed in real time gain resilience. Here's the hook many overlook. True market control is not about predicting exact prices. It is about having the structures and knowledge in place to act decisively when uncertainty arises. Finally, staying strategic means mastering emotional discipline. Fear, greed, and herd mentality are amplified in crises, but they are predictable forces. By recognizing the psychological traps inherent in every market move, investors can detach from reactive impulses and focus on long-term goals. This approach turns volatility from a threat into a proving ground, revealing who is prepared, who is informed, and who can capitalize on fleeting opportunities that most others miss. The difference between panic and strategy is often a single decision made calmly, confidently, and with purpose at the exact moment the market tests everyone else's nerves. Let me close with this. The $90 trap is not a price point, it's a mindset. It's waiting instead of preparing, it's reacting instead of planning. But you don't have to fall into that trap. You can choose awareness over anxiety, strategy over speculation, growth over fear. Remember, every financial storm creates two groups of people, those who panic and those who position themselves. Be the second group. Stay informed, stay disciplined, stay motivated, because in moments like these, fortunes are not lost, they are redirected. Thank you, and never let temporary chaos distract you from long-term vision.